Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Markets at all-time highs. Good time or great time to really have some of the best market voices. Dinshaw Irani of Helios joins in right now. He's our guest today to try and to tell us how is he thinking of what next from here on. It's a million, billion, $1 trillion question to answer. Dinshaw, thank you for taking the time out. But really, what's next from here?
Neeraj, thank you for having me on your show, and a very good morning to you, your
Thank you.
team, and the viewers.
Thank you.
So, frankly, Neeraj, I mean, we are quite comfortable even at these levels. Our feel is that India has entered a new league. Basically, always it's a very cliche term, but the fact is that we believe that India is today standing out not only in the region but also globally. And frankly, I mean, if you talk about the region, I mean, China, which is probably commanding a third of the flows in the region today, emerging Asia region I'm talking about, is having a bit of an overhang. In fact, China nowadays is getting compared to the late 80s of Japan when the acid bubble burst out there. And obviously, there were 4 decades. I mean, in fact, the Nikkei still hasn't recovered from those levels which they achieved in the late 80s, December of 89, in fact. Uh, the fact is that China is having this huge asset bubble playing out. They were hoping that with the opening up that they had done in October end, things will pick up, but they haven't. So there's a big overhang there, and the world is not too happy with the way China is what China is today. And frankly, I mean, you've seen flows moving out of China as such. But nowadays, you have regional funds which are coming out without China's way. So that's one big flow of money which is not going to happen to China. And obviously, India is an option for the flows in the region per se. And as I said, globally also, India seems in a very sweet spot today, mainly because of the fact that today we are the fifth largest economy, and the way we are moving, we are hoping to be the third largest by around 27, 28. I'm talking at CY, calendar year basis. So if that happens, obviously such a huge market moving at that pace cannot be ignored. So that's another positive point here. The pushback that we normally receive is that what about valuations? I mean, that's the major concern in the market, even today, even in domestic markets. Our feel is that if you were to look at, I mean, if you were to compare 20-year averages on valuations, obviously we're not be too far away from. We're like probably a standard deviation and a half away from those levels, which are at, I think, 15 and a half times forward earnings or so. But the argument that we give is that things have changed after demon for it. In fact, after demon, you saw this huge opening up of demat accounts, you saw huge flows coming into mutual funds, and you saw domestic supporting FI selling. I mean, in fact, taking away FI selling as such. So obviously, after 16, if you look at the valuations from 17 onwards, we are at 19 and a half odd times, and today also we are at around 20 odd times forward earnings. So I think we are in a very sweet spot. So we are very comfortable with the markets the way they are.
Am I understanding this correctly, that you are of the belief that अच्छी चीज है महंगी ही रहेगी because of the domestic flows, it will stay expensive. So if FIs want to come in, they will, in all probability, will have to buy India expensive.
Yes, I agree totally, Neil, because I mean, I actually feel happy that this time around it's the domestic movement. So last year you saw $20 billion outflows from FIs as such, and obviously the first 3 months also were fairly trying in terms of FI flows, but the domestic flows were enough to offtake that kind of. In fact, last year I think the DIIs invested $26 billion, and this year again the DIIs are positive. FIs have turned positive now from March and onwards. But the fact is that even in the domestic flows, $1.7 billion of SIP on a regular basis, which is the last month's figure that I'm quoting. Plus, you can add the NPS numbers, you can add EPFO numbers, and obviously you can also add the unit-linked schemes of insurance which come in on the equity side. So you're talking about $2.5, $3 billion of monthly flows coming in. So obviously things are going to remain expensive. The supply is not that much as compared to what the flows are. So we're very happy.
Got it. How are you therefore trying to piece your way around either keeping some of the investments which would have gained quite tremendously or putting in new money to work in pockets which, if they are promising earnings growth, are getting priced out, if not to perfection, then priced higher very, very quickly. How are you kind of navigating through that?
So actually, uh, we very concerned about our portfolio. In fact, we keep checking out our pegs, the price earnings to growth in our portfolio as such. And overall, the portfolio should be our feel is that should be below one. So that's why we play it in such a manner, the mix it in such a manner that we try to keep it somewhere close to 0.6, 0.7 times is what we try, and we are succeeding to that extent. But coming to the specifics, obviously there have been pockets where the performance has been huge. In some of the new age stocks, the relative performance has been fairly huge as such. So obviously we also get concerned that so this kind of outperformance will it continue or no. So you need to take off. You need to keep evaluating your portfolio on a regular basis, and need to keep taking off money off the table in some of the stocks where you think that the valuations are not are fairly stretched. And one more thing that we keep in mind, Neeraj, is that the valuations and growth have to be in sync. If the growth rates are high, you can allow a high valuation, but the expected growth rates are expected to come off their peaks. Obviously, those high valuations have to also correct to an extent as such. So you keep evaluating on that basis and keep removing money. So that's what we keep doing.
Got it. Just wondering, if the average peg is 0.6, 0.7, what is it that is substantially lower than that average? Where are those pockets wherein the peg ratios are so attractive?
So Neeraj, you can guess it very well. Financials. I think that is still an area where the pegs are fairly in favor of the companies. I mean, and frankly, I mean, if you, and by the way, we believe in history. We believe that history teaches a lot of lessons.
Sure.
So if you go back in history and if you see the economies which grow in such a manner, it's mainly the financials and consumption which really play a big part in this. Right? Financials, in fact, have a double role to play because they not only fund the consumption, but they also fund the capex is needed to take care of this consumption. Because as the consumption grows, your capital utilization, capacity utilizations will obviously go beyond 100. You need to put in more capex. So these are the guys who fund the capex also. So I think that's where there's a big area of comfort for us today. And fortunately for us, India has a lot of options in terms of financials which are given. And by the way, one more small trivia: I mean, the third economy to cross $5 trillion in terms of the globe as such. First two being US and China. And if you study those economies also, you'll see that it's mainly financials and consumption which really drove the numbers there.
Yeah. Well, actually, since you invoke that, two-part question. One, whether financials you believe, I'm presuming you're saying that financials are the pocket which will take the markets higher from here. Because frankly, I was looking at the last few months, right? HDFC Bank has virtually gone nowhere per se. There is some bit of uptick in some of the others, but for the first time in history, if SBI gets rated above sovereign, that's a historical thing as well. So one, would it be financials which you take the markets higher from here? And two, part two of my question, unrelated but related. You mentioned about learning from other pockets. We were doing some data crunching and looking at what happened to China and pockets which did really well when it moved from 2000 to say circa 4,000 per capita GDP. And one sector which stood out there was real estate. So I'm just trying to understand how are you thinking about both of these, rate sensitive as they are.
Yeah. So anyway, as I said, that our belief is that financials will really lead the rally from here on. Actually, you hit the nail on the head, because if you look at the three over heavyweights within the index, with the SDFC, ICICI, and SBI, they've frankly gone nowhere as such year to date as such, and it's the others which have driven the rally. But our feel is that the others which have driven the rally are more cyclical than actually structural growths out here. Though financials are also considered cyclical, but our feel is that the next 3-4 years, it's going to be a structural growth which is going to be built in now here. And I think in the case of HDFC Bank per se, I think it was more of a overhang of the merger. And obviously the outlook that with the merger, the stock will be like 13-14% of the weight, and most of the mutual funds will be overweight, or the FIs will be overweight, and that's why that overhang was created as such. But I don't think that's a big issue here because FIs are not driven by the 10% weight. They normally track the index. And in the index MSCI, HDFC Bank was never present. It was only HDFC. So there's an additional buying which will come in as and when HDFC and the bank merge. So that's a big overhang which will take care of it. And one more thing that I would like to highlight in financials is that till now it was mainly the NIMs which was driving the earnings growth, right? They were increasing their lending spreads much faster than what the borrowing costs were. So obviously that seems to have peaked out because interest rates have hit a peak. Our belief is that I don't think RBI needs to hike any further interest rates from here on. But the fact is that the earnings growth will come in mainly because of the credit growth, which is now kicking in. In fact, at the March quarter, where we expected that NIMs would have peaked and it'll be the credit growth which will kick in, both happened. I mean, the credit growth was way in excess of the high teens, and so was the case with the NIMs. They also expanded to that extent in certain banks. So that was a pleasant surprise, but I don't think that's going to go. And one more thing, Neeraj, that you should keep in mind is that normally, if the basics of a business kick in, that is when your the expansion of PEs happen. I mean, the revaluations happen, the valuation becomes higher, right? And the basics of this business is credit growth. And as and when that kicks in, obviously you'll see the valuations also moving higher.
Got it.
Oh, sorry, you were asking about the real estate.
Yeah.
So,
yes.
sorry, I missed that one. So our belief is also the same. We believe that actually we want to be cautious out here because normally you've noticed that in India, normally when such a cycle happens, most of the real estate guys get into a land bank kind of a gathering spree, and they go overboard in that. And when the cycle turns,
but we are not quite seeing that as yet, right, Dinshaw?
Yeah. So we're being very careful here. That's what I'm saying. That we're looking at probably very selective places which are mainly metro driven. There should be. I mean, they're more into luxury kind of a housing as such because rising interest rates impact more on the affordable bit and the lower end of the cycle. So that's why we're looking at more of a luxury place. And obviously, there also we're looking at guys who have got this rental income where the yields are expected to move up as and when the cycle turns as such. So these are the kind of places we are also very very comfortable in that area. But obviously, you have to keep valuations in mind.
Got it. Dinshaw, you guys were amongst the early movers, and by early movers I mean on the rebound on tech, on not IT services, but the tech-enabled platform companies after they hit those nadir levels sometime early this year or just last year. Now, what's the thought there? I mean, are you still constructive on them? Are you constructive enough to add new positions into any of those tech, whether fintech, consumer tech players?
So, good question. Actually, that's the one which I talked about when I said that in certain pockets, the outperformance has been very huge. I mean, it's like unbelievably huge. Even we hadn't dreamt of these kind of outperformances as such, but I think the market finally caught on to the story. But as I said, that we're very careful about our valuations. So, and then frankly, I mean, when you buy a stock with a weight in mind, and that weight becomes 2x of what you had in mind, obviously you look at pairing, and especially when the growth rates are not as commensurate as the valuations are, you look at pairing your positions to that extent that you want to be comfortable with that weight that you're carrying in your books as such. Structurally, there's no change in the story. Okay? It's mainly the valuations where it has they have pulled up as such. So that's why we are being cautious here. We've taken some weight off the table on these names as such. In fact, one particular name as such. I won't name it, but you can guess it. And obviously, structurally, we are very comfortable that these stories will continue in the future. We'll probably look at opportunities as when they come by to invest more. Even the new clients, we are looking at buying these names, but at a lower weight as compared to what they are in our books today.
Got it. Yeah. Dinshaw, when I was asking you the question, the other thing that I had in mind was this amazingly snarky or dipped in sarcasm release by by one of the players which supplies the software to the premier commodity exchange, and just unreal as to what's happening on the tech side as to somebody can't get this right for such a long period of time. But that was what it is. Actually, speaking of that, just one, maybe last one or two questions. Capital market related plays. There is a lot that's happening on the regulation side, even though the TRs have been pushed right now in maybe a small boost for AMCs, if you will. But I just wonder if any of the capital market plays, be it the brokers, be it the providers or exchanges or asset management companies, anything that looks attractive?
So basically, they are much more attractive players than these. And frankly, I mean, these guys have really gone off the charts in terms of valuations of what we remember them to be as such. And the way they are today, it's obviously not appealing to us. So there are much more options available in the financial space than market-related space. Anyway, we are exposed to the market in terms of so we don't want to take a further exposure in terms of the players also.
I get the drift. My final question: what's the Dinshaw, what's the bit of a dark horse bet that you might have taken? I mean, it's not necessary, or maybe you're contrarian there relative to what the market might be.
So actually, we haven't taken any contrarians today. What the contrarian bet we had taken was on the downside as such, and that has played out. And in fact, even today we continue with that. IT is one sector that we believe is going to go through a crunch period. And in fact, our feel is that the June quarter, which is supposedly the seasonally the best quarter for IT, you will see sequential degrowth in the June quarter because they came off a very weak base in March of this year, and obviously that trend continued. There's no change in trend. In fact, things are worsening. So I don't think the market is still giving that kind of a feel to these sectors. They're moving up. Of late, they've moved up, but our feel is that this is where there'll be a problem. In fact, in our long short fund, we short certain IT stocks.
Okay, well, teji barkarar hai. That seems to be the underlying message. Dinshaw Irani, thank you so much for taking the time out and being with us today. And have a great bull run in the second half of the year.
Thank you, Niraj. Always a pleasure to be on your show.
The pleasure is entirely ours. Thank you for taking the time out, and viewers, thanks for tuning in.